Are you thinking about buying a new home in the next 10 years? If you're in your late 20s right now, I'll show you how to plan your finances over the next 10 years so you can buy a home before you're out of your 30s. Let's break it down step by step so you can get started today. Buying a home is one of the biggest financial goals for a lot of people, but as you're likely aware, it's gotten pretty pricey. In fact, home prices have increased by 48% since 2020. So if you don't start planning now, it could become increasingly harder to buy a house in the next 10 years. But here's the good news. With the right plan and being intentional, it's achievable for you. Planning early gives you control over your finances and make sure that you're ready when the time does come. So with that being said, let's dive in. Number one, assess your current situation. Before anything else, take stock of where you are financially. Imagine that you're planning to take a trip, but you don't even know where you are today. Getting directions to the destination or even starting to head in that right direction is going to be very challenging. And the same is true with our finances. So list out all of your assets, your debts, your monthly expenses, income, everything like that. This helps provide you with a clear picture so that you know where all of your money is, where your money is going, and now you can figure out how much you want to allocate towards your new home, as well as other goals. To make this process even easier for you, click the link in my description to gain exclusive access to the Elements Financial Health Monitoring app. This is the exact app that I use for both myself along with clients to make sure that we're all organized and better understand where we stand financially. Number two, check and improve your credit score. Your credit score is an important factor when it comes to qualifying for a mortgage. Not only does it help you qualify for a mortgage, but the better the score, the lower your interest rate is going to be. And this lower interest rate could equate to tens of thousands of dollars of less interest paid over the lifetime of your mortgage. Now that we know the importance of your credit score and how it could save you thousands of dollars in interest, let's take a look at a few tips on how you can improve your score starting right now. Just like in tip number one, we have to assess where your current score is. You can do this through different tools, Credit Karma, Experian, likely your local bank or credit card company is able to show you your credit score as well. So for starters, figure out what is your current credit score like right now. With payment history being an important part of your credit score, make sure that you're making your payments on time. And if you need to, and what I would encourage you to do, because sometimes whenever your credit card payment due date rolls around, it could get lost in the shuffle. We might forget to pay that sometimes. Make sure that at least your minimum payment is covered on an automatic payment so that you don't run into missing payments. Because if you start missing payments, you're going to see your score start to tank. Credit utilization is another important part of your score. And essentially what credit utilization is the percentage of credit that you're using on a particular credit card. So for example, if your credit card has a $1,000 limit and you're using $500 on that credit card, your utilization rate is 50%. So for context, you want to keep this credit utilization number below 30%. So even as you start to pay off some of your credit card debt, a way to get a really quick boost in your credit score is simply reduce this credit utilization rate. So maybe you look at cards that have a lower credit that you currently are using or a lower total limit on that particular card, and you pay those off first because that's going to bring that credit utilization down and you'll likely see an increase in your credit score even in the short term. Another thing that you can do in the short term to boost your credit score is use a tool like Experian Boost. Effectively what this does is it has you enter your information in, it looks through your transaction history for bills and utilities, things like that, and sometimes it's able to include those as part of your payment history. Now, with on-time payment history and more on-time payment history, that could potentially give you that quick boost in your credit score. Something that can negatively impact your credit score on a short-term basis at least is applying for a lot of new loans. If you're getting a lot of new credit, the credit bureaus see that as someone who's potentially overextending themselves, and in the short term, you'll see your credit score decline. So only take on debt that you absolutely need. And one last thing when it comes to your credit score, monitor and check it on some level of a consistent basis. What this is going to allow you to do is see if there's any fraudulent activity. So one, definitely get rid of that. Or two, if you notice a massive change in your credit score, whether up or down, especially down, that's a really good reason to then go in and see, was there fraudulent activity on your account? Did you get sent to collections from a medical bill that you weren't sure of? But making sure that you're checking it and monitoring it on an ongoing basis will help you catch these things much faster compared to rarely checking. If you follow these tips, make sure that your payments are on time, maybe you use an Experian Boost or another tool like that, and minimize your credit utilization rate, you'll see your credit score rise over the long run. So depending on your current situation, maybe there's an opportunity for some quick boost to your credit score, but other things like on-time payment history, of course, course, you can't force yourself to be older yet, so just keep being consistent when it comes to paying off your debts, and you're gonna see your credit score increase over the long run, and that's going to help you buy your house. Number 3, set a price target for your future home. Think about the type of house you want and where it's located. Once you have this, you can use an inflation calculator to see what the cost of the home might be in, let's say, 10 years. For example, if a house costs $300,000 today and it increases by 3% per year, well, in 10 years, that house would be a little bit over $400,000. Now, I don't think that you need to nail down an exact price because no one knows exactly what home prices are going to be in the next 3 years, 5 years, let alone 10 years, but having at least a general idea is going to be really helpful when it comes to buying your new home. Number 4, calculate your down payment. You've probably seen a lot of gurus that tell you that you need to put 20% down, but I'm here to encourage you and tell you that simply is not true. Sure, it would be ideal if you could put 20% down because that would help you avoid private mortgage insurance, or PMI for short, which is essentially an extra fee that gets added onto your monthly payment until you have at least 20% equity in your new home. But don't let PMI alone prevent you from buying a house. Many loans allow you to put down as little as 3.5%. The important thing to keep in mind is what your debt rate will be. Your debt rate is your debt payments divided by your gross income. And once you factor in your new mortgage payment, which of course, the more money you put down, all things held equal, the lower your monthly mortgage payment will be. So once you figure out approximately what your new monthly mortgage payment would be, put this into your debt rate calculation. If it's below 30%, then likely that will free you up to have plenty of cash flow to be able to still save and also spend money on things that you enjoy. But if this is going to make your debt rate go above 30%, from my experience working with hundreds of clients, there's something specific about that 30% number that anytime your debt rate goes above 30%, things just start to feel tight and constrained on a monthly basis. So again, big thing to keep in mind, make sure that your new debt rate, once you factor in your new mortgage payment, whether you put down 3.5%, 20%, 30%, regardless of what that is, your new mortgage payment added to your other debt payments that you have on a monthly basis should keep that debt rate below 30%, and I think for most people, you'll be in a pretty good situation. Number 5, account for additional costs beyond just the down payment. Most people have a pretty good handle on what the down payment might be. In fact, if it's a minimum of 3.5% or even 20%, you know exactly what that number is. But what's more challenging and much easier to then overlook are other expenses. When you move into your new home, what do you want? Probably new furniture. You also have closing costs, titles, repairs, all sorts of other things that could happen or could be expenses right at the very beginning of the move-in process. So you really want to be mindful. And again, you don't have to get this number down to the T, down to the penny, but it's very important that you at least have a general idea and that you save more money than just what the down payment is, because I can assure you from buying a house with my wife, there are certainly more costs besides just the down payment. Number 6, ensure that you have a healthy emergency fund. Having a healthy emergency fund beyond just what you've saved for your down payment, moving costs, closing costs, and all those other expenses that we just talked about is incredibly important. The last thing that you want to have happen is move into your new home, you've got your new furniture, your appliances, just paid the movers to bring everything inside, and then have the hot water tank break, and all of a sudden you're swiping your credit card to put that on because you don't have a healthy emergency fund. Now you might be wondering, what is a healthy emergency fund? If you do a quick Google search, you'll likely see to have between 3 to 6 months of expenses. But to add a little bit more clarity, and of course, I don't know your personal financial situation, but typically if you have a secure job, your W-2, or maybe you're a teacher, maybe you can lean more towards the 3 months of expenses. If you have more variability in your income, maybe you're an entrepreneur or salesperson that gets a lot of their income based on sales commission, well then maybe lean more towards that 6 months. But ultimately, one of my favorite questions to ask my clients is there a particular number for your emergency fund that just seems secure? Helps you feel more stable with your finances. Whether that's closer to 3 months or whether that's 6 months, the emotional side of finance is really important here. So I'd encourage you to ask yourself that question to help guide you to figure out if closer to 3 or 6 months, or maybe even a little more, depending on your case, might be better for you. Once you've figured out how much money you want to have ideally inside of your emergency fund, a few key things to remember before we move on is 1, keep your emergency fund in a separate high yield savings account. What this allows you to do is both physically, but also mentally separate it. So it makes it a little bit more challenging. If you do see something really nice that you want to purchase, you're probably going to be less likely to then pull it from your emergency fund. You also want to keep a separate high yield savings account for your down payment fund, so you're not commingling funds and you don't know how much money you actually have, how much money you have for your down payment versus your emergency fund. Again, keeping these separate in high yield savings accounts. At the time of this video, you can get yields around 4% in that high yield savings account. So really encourage you to do that. Also, very wise to automate your savings to your emergency fund as well as down payment account, where instead of having to think about how much you want to put away every single month and then manually press a button on the screen to do the transfer, it's very wise to simply automate it ahead of time. Because one of my favorite quotes, it's true whether you're a saver or a spender, is if you can't see it, you can't spend it. So I'll leave you with those couple tips on emergency fund. And number 7, align your home purchase with your values and long-term goals. If you don't plan to be in your home for at least 5 years, then it likely doesn't make sense. Since we already talked about the upfront cost, it's really important to plan to be in your home, typically for around 5 years. Now, you don't have to lock in the rest of your life living in this one particular home, but if you know that you want flexibility in the next couple of years to potentially relocate, then buying a home is not going to be the right time for you. But if you don't have any plans, at least in the short term, to relocate or move locations, then buying a home could definitely make sense for you. Also, here are a few questions that you can ask yourself to make sure that this home purchase fits with your lifestyle. Does this location support my career and family goals? And will this house allow me to live comfortably without sacrificing my other priorities? When your home purchase aligns with your values, it becomes more than just a financial goal. It's about building the life that you want. So picture yourself in your 30s. You're walking into your new home and you're feeling great because not only did you buy your new house, but also you feel in control of your finances because you started planning today. If you're serious about buying a house by 2035, start today. Assess where you are financially, create a savings plan, and take action on improving your credit score if you need to. And if you want personalized guidance, creating a strategy tailored to your unique situation, click the link in the description and I'd be happy to help. And don't forget to like and subscribe. I'll see you in the next one.